Let's talk some volatility. Let's talk some trading strategies with Noel Smith. He's a CIO at Convex Asset Management. He's got a deep background in trading options all the way to being a seed investor in KCG and what would become Virtu. Noel, great to have you here on the Schwab Network.
Thanks for having me.
Okay, so tell me what you're thinking about right now. We had mostly like this big vol event that captured everybody's attention. You got macro stuff mixed in. Today seems like this really healthy rally, but given where we came from, do we need to go back a little bit? Walk me through here how you're thinking about the market right now.
So it was a really unique opportunity. The volatility response that happened on August 5th was so outsized relative to really anything else. So I did an interview previously, and I said that I was going to fade that volatility move, and it ended up working out really well. But some of the indicators that we look at in terms of why would you want to fade something like that, and what is the risk inherent in that, is some of the stuff that I thought would be interesting to talk about. Because if you look at the market structure overall, writ large, wasn't that much of a freak out. It was really just a volatility freak out.
Some have called the VIX spike like a fake because it all happened overnight in pre-market. Would you describe it that way? Is it worth even going down that road?
So it's a little bit of both. You could have traded it in the sense that if you wanted to sell your house for a quarter right now, you could. The markets were really wide and it was difficult to trade, but it was tradable. And unfortunately, I know some people that did make some really substantial moves prior to the market opening. But in terms of the market open stuff that most people would normally look at to trade, it was a much more civilized market. Still a large move, but it was nowhere near the VIX 65 that people talked about. If you look at the August future when it opened, I think it was like 37, which don't get me wrong, it's still a really high number, but it's not 65.
Okay. It seems like another way to frame this is basically, do you think that the ramifications of this event will be more similar to VIX events that were like above 50 or those below? Because if you put it more in the category of like Volmageddon 2018, then okay, maybe just a trade went bad and we'll go on our merry way. But when you've really only got comparables above 50 to like major economic turning points, whether it's COVID or GFC, then you've got a very different answer.
Exactly. So what you're looking at is a response that is much more indicative of a much more serious event. And a yen unwind and volatility that was creeping up the week prior, and then all of a sudden an overnight freak out because of the potential of the Japanese market blowing up. It's just not the same. It is a structural trade as opposed to a macroeconomic trade. And frankly, the market has really borne that out since then. If you look at the rally that we've had and the squish and vol, that really has no precedent. The ascendancy in vol and then the declination in vol, the rate of change on both of those things was so substantial to not really have an analog.
That's a really good point. That's a really interesting point, because then it maybe allows us to kind of fade some of the macroeconomic implications as well, given that there was a bad employment report mixed in there. Today, good data helping drop that VIX even more, though. Does that kind of speak to a macro force that was mixed in there as well with the poor employment?
Yeah, I mean, a lot of people, ourselves included, we take risk on, risk off postures as a result of the macro climate and also what is going on in the volatility landscape. So nothing really moves in isolation. So if something goes crazy, if gold goes down 50% or up 50%, you can't not notice how that has bleed on and knock-off effects into other asset classes. So if you're looking at the marketplace, and everybody is, and the VIX goes to 65, you can't not think, what am I missing? What else is going on? How does this affect the rest of my portfolio?
I think like in 2022, our inflation bear market where VIX was elevated but not spiking that much. Is there like an inverse world of that where maybe our general baseline is calm, like an average VIX, but like every employment print is scary if it means it's going to be like the last one before recession? Is there any precedent for that type of environment? I guess the question I'm asking is basically what type of life do you think vol takes on from here?
I think it lives a pretty short life. So if you look at 2022 relative to last week, you had the market down from peak to trough something like 25% in 2022. And it was down maybe 5% last week, which is nothing close. And volatility was so muted in that 25% move in 2022 relative to what just happened. Puts didn't explode. There was no reach for VIX calls. It is just a very different environment. And it was flash of a pan. So it didn't act anywhere near the same. So the idea that you would fade a move like that, to me, seems a lot more reasonable.
Okay. So Noel, the other thing that was going on in the market, also vol-wise, before the big spike, before the big crash, was the dispersion trade. You could kind of look at it from a vol perspective, which many did. You could look at it from just an equity leadership perspective with the concentration at the top. We had a really interesting period where there was like this massive dispersion because all the big tech was winning, and then we tried to flip it on its head with the rotation. Didn't really work, and a lot of vol traders I know were basically partying in there in the meantime, playing that spread between index and specific companies. Is there any of that left?
There's a ton of it left. So as previously discussed, is it a stock picker's market? And if you think it is a stock picker's market, that bodes well for dispersion correlation trading. So bear in mind, dispersion and correlation trading is the same word twice. It's just yin and yang of the same idea. So the idea that stocks have a mind of their own and they don't move as a unit is beneficial to a dispersion trade. And while that trade lost money in the VIX spike, the trade is still very much on. And if you look at the relative location of that trade going into it, it was so low. So yeah, it went up from a low, but it's also much lower than it traditionally has been. So I think there's still a lot of life in that trade. And if you look at the trading that's happened since the event, it's still definitely on. And I think it's frankly a good environment for it because we don't really know where rates are going as well.
Okay. Can you give me like a little 60-second primer on what you're doing? Any secret sauce from what you guys are currently in at Convex? We got about a minute. Happy to hear like structure on a trade or anything that you're working on.
Sure. Well, I can't discuss specific trades. I can say that we always pretty much warehouse volatility. So the event for us was a gift in the sense that we always have on some kind of a hedge. And if the market freaks out like it did, that's something that we can monetize. So I would say that if you had that luxury, it is something that you should have monetized, and we did. Moving forward, we also re-engaged some of our short vol ideas, and those have been working since August 5th, and we think that they will continue to work for a while. And we're kind of reverting and recycling back into more of a risk-on posture. It's easy to say when the market's up 167 bips, but the indicators were there even before that happened.
Hey, one question for you. Last thing, Knowles, when I look at the VIX curve, especially with the vol dropping and the short in so hard right now, it's kind of there's a few kinks and it's kind of elevated in somewhat of an unusual way. Is there anything to be garnered there?
So you have the election and then the election uncertainty that comes around that. I mean, using 2016 and 2020 as an analog, we're electing to basically short the front and be long the back. We don't know any more about the movement of the market than anybody else, but the rate of change in the front, we feel will be more swift than the rate of change in the back. So we think that we can protect ourselves in the back while make money and profit in the front.
Okay.
Being short it.
Okay. Understood. Noel, thanks for the catch up. Looking forward to keeping in touch.
Thank you.
Absolutely. Noel Smith, CIO, Convex Asset Management.